Good morning. The United States has announced high port fees on Chinese-owned or Chinese-built ships that will go into effect shortly. Here are those again. The objective of these new fees is to reshore the American shipbuilding industry. That's going to take a long time, if it happens at all, and global shipping companies are already responding by shifting supply routes and, wherever possible, using ships built and operated by other countries to get around some of those new fees. This report is part 2 of this one, which we uploaded earlier, and the link is in the video description, so you can review some of the ways they're doing that. There are 2 serious problems for everyone in the shipping business with these new fees. First, they're scheduled to go even higher over coming years. The cost just for one Chinese company, COSCO, and its subsidiaries will be over $2 billion next year, and higher still in the future. But it's a hit to all the other global shippers too, because of how many Chinese-built ships are in their fleets right now, and how many more are on the way. The dark blue lines are the percentages of existing fleets which are Chinese-built. COSCO is over 60%. Most of the others are over 20%. But the light blue lines show the new ships that are added to the fleets. These are ships under contract and under construction now. And for almost all these companies, over half the new ships coming will be built in China. The headlines are all about how COSCO and other Chinese shippers are being targeted by the new fees from U.S. ports, but they're coming for everybody. China's shipbuilding industry builds ships faster, has lots of capacity, builds with high quality, and well priced. In August, new orders for Chinese ships were 84% of the world's total. In June, it was 65%. Takeaway there is that China is gaining new ship orders even after the new high port fees on Chinese-made vessels were announced. To Chinese officials, this does represent a new salvo in the trade war that is directed at their industry specifically. But in this case, Chinese regulators are in an unusual position. The trade war is being fought by Western governments with tariffs and import restrictions. China is using its dominance in supply chains and its ability to source easily from friendly countries. Retaliatory tariffs from China, when they do go on, they do enormous damage to American farmers and Canadian lobstermen, for example. But that's only true because China does have other sources of supply. High tariffs go on U.S. and Canadian crops and seafood, and Chinese firms just shift their buys to South America or Vietnam, for example. But this situation is trickier from a trade war perspective because the American merchant marine fleet doesn't really exist at all. The U.S. merchant fleet was crashing to zero a long time before China was getting serious about building ships. In 1950, the United States had over 3,000 flagged vessels, which made up half of the world's tonnage. Now those numbers, respectively, are 178 and half of 1%. Chinese-operated ships passed those of the United States in 2002, but at that time, China was just standing still while American ships just sailed off to be run by companies in other countries. Chinese production went parabolic starting in 2010 or so, while the U.S. merchant fleet flatlined. So the problem is that there is no U.S. shipping industry to retaliate against. But under new policies announced by China last week, they may be targeting the U.S. shipping industry much more broadly. Matson is the biggest U.S. shipping company, but it ranks just 29th largest. These new rules from China could raise the cost for any Matson ship unloading cargo in China. But what has shipping analysts concerned is the language of the new Chinese regulations, which do not even mention the United States at all. The way these new rules are written, they give Chinese officials wide discretion to raise fees for ships coming to Chinese ports based on ownership. Big money is made by Wall Street investors and institutions who own and operate ships in low-cost countries, and China could simply retaliate with high fees on any of those ships heading this way. We'll go through just 2 as examples of what the Chinese could have in mind with their new rules. Star Bulk Carriers is based in Greece and does a lot of shipping business in and out of China. Star Bulk also has a lot of ships on order from Chinese shipyards. But the company itself is traded on the NASDAQ in the United States, and almost all of its major institutional stockholders are American investment companies. AllianceBernstein, for example, owns over 3 million shares worth about $70 million. Global Ship Leasing is another one. It's an American company with container vessels, but it's headquartered in London. Ticker for them is GSL, and over half the company's shares are owned again by major U.S. institutions. These shipping companies are also attractive to investors, especially U.S. pension funds, for example, because they do tend to pay high dividends. The shares for both of these companies are here. These are American companies traded on American exchanges and owned by American investment firms. A long time ago, these investors realized they could make more money by owning ships, but operating them from elsewhere. China understands that too. And with these new regulations, officials here could simply do what we've done and assess port fees based on that proportion of ownership whenever these ships dock at Chinese ports. It will also be interesting to watch what will happen in Chinese-owned and operated ports across the world. Remember that Costco is not just a giant shipping company, they're also a giant port operator. 39 ports and 379 berths across the world, and it's in negotiations to scoop up a lot more from C.K. Hutchinson. Hutchinson has 2 ports, one at each side of the Panama Canal, among a lot of others. Lloyd's List says that's very important, both as a way to reduce the impact of the high tariffs directed at them, but also for leverage in everything else all these other shippers hope to do. We don't want to chase our tail with a lot of what-ifs and hypotheticals, but let's just remember the dominant position China is in on the shipbuilding and in the logistics, and the reason all these ships are going back and forth from China in the first place. It's China that buys so many of the raw materials coming out of the ground across the world, and it's Chinese that export so many of the manufactured products across the world. And it's just hard to see how these new U.S. port fees will move the needle on any of that. But it's clear that American consumers and importers will be paying a lot more. And now probably our investors are too. This is the Yulong River in Guangxi. Be good.